In a world where change is the only constant, Mo Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey.
You know, the moment the calendar flips, every single major player starts dropping their housing forecast for the year after next.
Oh, yeah.
And for 2026, I mean, the noise is just deafening. Trying to figure out where the market is headed from one article. It's like trying to navigate by looking at a single star.
It is. And the forecasts are so complex, they often contradict each other. And let's be honest, some are deeply self-interested.
Exactly.
So for this deep dive, what we've done is taken the most influential sources. I mean, a massive stack of 9 primary reports. We're talking NAR, Fannie Mae, Freddie Mac, Zillow, Redfin, the MBA.
And the big analysis from places like the Wall Street Journal and CNBC.
Right, all of them.
And that is a monster pile of homework.
So our mission for you, for the person who's trying to get ahead of the curve here, it's not just to summarize these.
Right.
It's to find the consensus and, maybe more importantly, identify the points where these huge players just fundamentally disagree.
We're drilling down on sales, on pricing, and on buyer psychology for 2026.
The goal is that you walk away from this with that foundational knowledge on the rate outlook, the hard facts about inventory, and why affordability is still the absolute central challenge. All synthesized from these giants.
Okay, let's unpack this.
Let's do it.
If you really want to understand housing, you have to start with the cost of money. So let's dive into that economic foundation first. I mean, the monetary drivers that just underpin everything these groups are calculating.
This is where NAR, Fannie Mae, Freddie Mac, and the MBA spend most of their energy.
And mortgage rates are the main event, right? The primary throttle.
No question. And when we blend the outlooks from NAR, Freddie Mac, and the Mortgage Bankers Association, we start to see a very specific trajectory taking shape for that 30-year fix.
Which is?
The consensus is a gradual, kind of uneven decline throughout 2026.
Okay, what does gradual actually mean in hard numbers? Are we talking about rates dipping back below 5% again, or is it something more conservative?
It's more conservative, and that's a really key insight here. Nobody is forecasting a return to those pandemic lows.
Not even close.
Not even close. The common ground is that rates are expected to ease from where they are now, say high 6s, low 7s, and settle somewhere in the mid to low 6s. Maybe brushing the high 5s by the very end of 2026. But the critical thing to see is the rate of that decline.
How fast it's happening.
Exactly. It's slow enough that it keeps a lot of current homeowners locked in, but just low enough to maybe entice back some of the most determined buyers who've been on the sidelines for years.
And the second you mentioned those mid-6s, we crash right into the issue that Fannie Mae and Zillow are just obsessing over: affordability.
Yeah.
It's not just about the sticker price anymore. It's that whole ratio of income to the total monthly payment, and that's where inflation really comes into play.
Fannie Mae, I think, provides the most detailed link here. They specifically highlight that general inflation, so stuff outside of housing, is influencing affordability calculations in a really deep way.
How so?
Well, they argue that even if the Fed kind of wins the broader fight against CPI, if wage growth continues to lag behind the cumulative increase in housing costs and, groceries over the last few years,
then the gap just gets wider.
The affordability gap only widens. Even if rates drop to 6.0%, a buyer in 2026 is facing a drastically different reality for their purchasing power than they did back in 2020. It's the accumulation of all that financial pain.
That's such a crucial distinction. You can't solve affordability just by cutting the mortgage rate. You need a fundamental shift in prices or incomes.
Exactly.
Now, let's bring in the lenders themselves, the Mortgage Bankers Association. They're not just predicting home sales, they're tracking purchase and refi activity. Why is their little niche so important for the 2026 outlook?
Because it tells us where the capital is actually going. The MBA is the only source that gives us these really detailed refinance projections.
Okay.
So if rates drop faster than expected, let's say they hit 5.5% in 2026, the MBA forecasts this massive surge in refinancing.
Right. Everyone who bought at 7% is going to jump on that.
Yeah, immediately. And the consequence, lenders shift their resources, their underwriters, their entire focus away from purchase mortgages for new buyers, which are complex and slow.
And they move toward the easy, profitable refi business.
You got it.
So a rate drop which on the surface sounds like great news for buyers, could paradoxically lead to a capital crunch or at least a slowdown in service for the people trying to actually buy a house. That feels like a massive divergence point.
It is. It's the classic unintended consequence. The MBA is basically warning, hey, don't celebrate too early if rates drop fast, because that redirection of capital could make the whole purchasing process harder for the average person.
Which would keep the overall sales volume numbers constrained no matter how much demand there is.
Exactly.
Okay, so if money is the bedrock, what about the actual houses? Let's switch gears from the monetary drivers to the physical supply crisis. This is segment 2, where we're looking at reports from Freddie Mac, Redfin, and the Wall Street Journal inventory pricing and this whole idea of normalization.
Inventory is the elephant in the room. I mean, all 9 sources point to its continued tightness. Freddie Mac and Redfin both dissect this lock-in effect.
And here's where it gets really interesting.
Yes. Redfin estimates that something like 70% of current mortgage holders have a rate below 5.0%.
70%.
70. These aren't just people who might not sell. These are people who are financially disincentivized to ever sell unless they have a massive life change or have to move for a job.
That 70% figure, I mean, that's not just a tight market. That feels like a structural ceiling on the available supply. Does that just kill any hope of prices coming down in 2026, even with slightly lower rates?
It creates a permanent sort of unnatural floor under home prices. Freddie Mac's specific price forecasts, when you put them together with NA's, show appreciation slowing down a lot in 2026 compared to recent years.
But not going negative.
But they almost never predict outright national price declines. The tight inventory just prevents that correction from happening across the board. We might go from, say, 5-7% annual appreciation down to 2-3%, but that's not relief for a first-time buyer.
Not at all. And the Wall Street Journal had a specific framing on this I thought was worth exploring. The headline was basically, will housing normalize in 2026? That question captures the anxiety of the whole market.
It really does.
So does the consensus from these sources suggest we're heading back to some kind of balance? Or is that whole market rebound narrative just optimism that's masking deeper problems?
The consensus leans heavily toward the latter. A true normalization would mean supply meets demand, prices are aligned with wages, and turnover is healthy.
Right, a normal market.
But if the forecasts are suggesting slow appreciation combined with chronically low inventory, then the rebound they're talking about is purely in terms of transaction volume picking up a little bit because of lower rates.
So it's a return to growth, but emphatically not a return to balance.
That's it. Normalization, in the way you and I and most people think about it, is just not in the cards for 2026, according to this stack of data.
And when we talk about inventory, we have to acknowledge the market isn't just one big thing. Redfin specifically talks about migration as a factor, which seems to almost contradict that tight national inventory story. How do we reconcile those two things?
It's the kind of nuance that really separates, an informed person from a casual reader. Freddie Mac gives us that national, picture-tight, constrained, persistent lock-in.
Mm-hmm.
Redfin, though, specializes in the geographical breakdown. Migration trends, especially that continued move from expensive coastal hubs toward the Sun Belt and secondary cities, think Texas, Florida, that creates massive local inventory pressures.
So while the national inventory number stays low, certain high migration markets might actually see an oversupply of listings as people move in and then quickly realize the infrastructure or the local job market can't support everyone who just showed up.
Exactly right. Redfin's analysis helps us see that the inventory crisis in 2026 will be felt unevenly. High-growth areas might see a temporary cooling or maybe some price stability because sellers are actually entering the market there.
Whereas older, stable markets in the Northeast or on the West Coast will just stay locked solid.
Locked solid because of those rate disincentives. The overall number is tight, but your experience as a buyer is going to depend entirely on your zip code.
Okay, let's pivot now to segment 3, to the human element. Because houses are such a huge financial and emotional transaction, the market isn't just driven by balance sheets, it's driven by psychology.
Oh, absolutely.
And this is where we look at Zillow, Redfin, Housing Wire, and that sort of overarching tone picked up by outlets like CNBC.
And we have to understand who is actually out there buying. Zillow provides some fascinating analysis on buyer types and competition. The big insight here is the changing makeup of the buyer pool. Because of this high-rate, high-price environment, we've seen a disproportionate rise in cash buyers, high-net-worth investors, and people buying second homes.
And those groups are basically rate-proof. Their participation completely changes the game for the first-time buyer who needs a mortgage.
Precisely. And Redfin complements this by looking at the broader demographic trends. The demand is structurally persistent. You have this massive millennial and older Gen Z population aging into their family formation years. They need houses.
Sure.
But if the market is increasingly dominated by institutional money or cash-rich people, that persistent need doesn't translate into sales for the average person. It just raises the price of admission.
And here's where we hit the real tension point for 2026. The Wall Street Journal uses the term buyer fatigue to describe those consumers who are just worn out and priced out.
Right.
But then you have Fannie Mae and Housing Wire still talking about powerful, persistent demand. Are these sources talking about two totally different groups of people?
They're describing two sides of the same coin. Persistent demand is the demographic reality. The millions of people who need shelter and want to build equity, it's the latent energy in the market.
Okay.
Buyer fatigue, on the other hand, is the psychological withdrawal. It's caused by the cumulative pain of losing bidding wars, high rates, high prices. The WSJ argues that fatigue is leading to a temporary, voluntary pullback from middle-class buyers.
So the demand hasn't vanished, but the will to actually transact has just been crushed by the market conditions.
It's been suppressed.
How does this resolve itself in 2026?
It resolves itself through sentiment. Housing Wire specifically tracks mortgage rate sentiment. They track what buyers expect to happen.
Mm-hmm.
So if the majority of those fatigued buyers believe that rates have peaked and the slow descent is reliable, even if rates are still pretty high at, say, 6.2%, that sentiment can translate the latent demand back into actual sales, which is what NAR projects.
But if the market gives any sign that rates might tick up again?
The fatigue wins. Buyers retreat, they prioritize saving, they keep renting.
So we have this incredible tug of war, demographic pressure versus economic fatigue. I want you to synthesize the overall general tone of these 9 forecasts for 2026. CNBC always tries to capture the market's emotional temperature. Is 2026 a story of optimism, or is it caution?
It's a story of qualified optimism.
Qualified how?
The optimism is rooted in the belief that the rate environment will improve, which will relieve some of that payment pressure and trigger a modest increase in the number of transactions.
Okay.
However, the qualification, the heavy note of caution, is focused entirely on affordability and inventory. They're all basically saying, yes, things will get technically better than 2024 or 2025, but the market is going to remain fundamentally challenging for anyone who isn't a cash buyer.
Because the underlying structural imbalance of supply is still the dominant constraint.
It's the dominant constraint.
So what does this all mean? If you stuck with us through all of this, you have now internalized the distilled wisdom and the key disagreements from 9 of the most influential reports defining the future of housing.
And the final takeaway for you is this. Understanding the 2026 housing market means you have to track 3 interdependent vectors at the same time.
Okay, what are they?
First, economic policy driving the cost of money and how that affects both purchase and refi capital. Second, the structural supply dynamics, that tight national inventory contrasted with Redfin's localized migration surges.
1/3.
And third, the psychological factors, that tension between demographic demand and buyer fatigue, which is mediated entirely by mortgage rate sentiment. The most well-informed view requires you to weigh Fannie Mae's inflation focus against, say, Zillow's changing buyer composition, rather than just taking one report as gospel.
And that rapid, nuanced understanding is exactly the value we wanted to deliver. The key takeaway for you is recognizing which variables are expected to be the most active drivers of change in 2026. It's the interplay between the slow release of inventory, the struggle for any kind of affordability correction, and that turning point of buyer sentiment that will define whether 2026 feels like a recovery or just more of a grind.
And that leads to a final provocative thought for you to consider, which is based on all these findings about cash buyers and fatigue.
Go on.
If this slower transaction growth persists through 2026, driven by the average consumer just not being able to afford to get in, will that fundamentally shift the focus of market stakeholders like lenders and builders entirely away from catering to the first-time home buyer?
Wow.
Will the market instead pivot permanently toward institutional and investor types, fundamentally changing the character of housing from shelter into a pure financial asset? That is the long-term implication embedded in this stack of source material, and it's something worth exploring over the next year.
In a world where change is the only constant, Moz Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey